Anastasia, would you call it a Goldilocks jobs report?
I would call it a Goldilocks jobs report. I think it is definitely buy stocks, not necessarily sell bonds report. It is a strong number that we expected. Our expectation was about for 190. We got 196. So I'll definitely take that. If you look at the last 10 years, there's really only been 3 instances, including the last one, where we saw a 20-ish number, which we saw last February. So we were expecting a snapback. And you couple that with some of the ISM data that we got earlier in the week, this is stock positive.
Michael, we can say with conviction, can't we, that February was a freak jobs report after this, can't we?
You know, we always look at the rolling 3, 6, 9, 12-month numbers, and you're kind of right at the pace you've been at, right? Last year, you're adding jobs just over 200,000 a month. This year, you're just under it. So it's really not a surprise. It's nothing that we haven't seen before. I
want to bring Rick Rieder into the conversation as well. Rick, your thoughts?
So I think everybody described it right. I think there are a couple of things I thought were pretty interesting. One, you know, we talked about the transformation of the economy from manufacturing to services. You had negative manufacturing jobs again this month, so you're seeing some deterioration there. By the way, some of it is near-term weakness that you're seeing in trade, in Germany, et cetera, and the rest of the world. But manufacturing and huge growth again in terms of, you look at education, you look at leisure. Anyway, that shift is a big deal because that shift means less inflation or more stable inflation. I think is a really big deal. I think the transformations, we talk about these average hourly earnings that come out and inflation. You have an economy, as you described in Goldilocks, when people say, my God, watch the Phillips curve, watch for, it's just not, I mean, we're going to talk about it every month, it's just not going to happen. Moderate inflation acceleration, pretty good. Moderate wage inflation.
Explore this further for us, because it's your base case that the cycle highs we have seen in wage growth, just off them this morning, you don't think they translate into headline price pressure, consumer price pressure. Why not?
No, I'm stubborn on this. I mean, I think it's the other way. I think you have a dynamic, the traditional way we used to look in the 50s and 60s or the 80s and 90s. You had a manufacturing-oriented economy. It was goods-oriented. It was commodity-oriented. You saw it in fuel. You saw it in chemicals, et cetera. You have an economy now that's a service-oriented economy. What happens more now, and you're seeing it in earnings, is you get wages up, margins press down, you get compressed. Companies have to think about, what do I do with inventory, what do I do with capex, and you create, and because you don't get pricing power in today's world. In the world we live in today, you can't just raise prices. Companies would have done it already because you would get a higher ROE. So now, because of, for a variety of reasons, price transparency, a globalized world, you don't get that transmission benefit.
Does this resonate with you, Anastasia?
Yeah, it is definitely interesting. It is a shift to the service economy, and obviously when we look at the CPI or PCE basket, we see that 65% of the basket is represented by services, which means the greatest price pressure there should be wages. So you would think that would translate to some overall headline inflation, but that's not been the case. And if you look at PPI prices, if you look at goods prices, all of that has been trending down. So that disinflationary trade is still definitely very much real.
I want to get the view from Barclays and bring in Michael Gapen, Barclays chief US economist. He joins us from the trading floor over there. Michael, always great to catch up with you post payrolls. Your initial thoughts, please.
I would agree with everything that's been said. I think our message has been ignore the January, February data flow because it's volatile on account of the shutdown and other factors, and look for the March data. And we have 3 really good data points this week: a mid-50s reading on the ISM, a 17.5 million unit rate of auto sales in March, and now 196 on employment growth. That suggests businesses haven't lost confidence and continue to hire. I agree that the wage number was a little bit softer, but the product of employment, hours worked, and wages still mean aggregate nominal income growth of about 5% in Q1. That's exactly where it was in Q4. Should keep the consumer on track for a reasonable pace of consumption growth in the first half of this year.
Michael, ahead of the payrolls report, I always get to catch up with the good and the great on Wall Street. And the story I was told continually ahead of this print is that at some point, the labour market's maturing, payrolls growth has to decelerate. And then what do? We print pretty much everything we've printed over the last 2 years, something in and around 200K. When does the deceleration come through?
Not until growth probably drifts down towards 2%. I think what we've seen, and what has gone a little bit against even my expectation, is that the rebound in prime age participation, it didn't show up this month, but over the last, say, 6 to 12 months, we've had a rebound in participation. So we've been able to add those jobs by drawing people back into the workforce and delaying retirement. So both men and women, their participation has risen, and I think that's allowed this to go on further.